Starting with Keith Fitz-Gerald. Keith, again, we're looking at a market that's very tentative. I don't know what is so horrible about what Powell said. We want prices to come down. We knew that they would raise by 75 basis points. The U.S. greenback, the dollar, is incredibly strong, hitting fresh 20-year highs against the euro and the yen. So isn't today a day where you pick up some cheap stocks, maybe?
Oh, I am absolutely with you. Volatility is an opportunity. You know, it's funny, Liz, because the market is the only store in the world where people run the other direction when stuff gets put on sale. So personally, I think the Fed lost the plot months ago. I use days like today very clinically. I'm going for stocks that are must-have goods and services, especially on days like today.
Yeah, Dow and S&P are actually no, I believe. Yeah, that is that the session low now? I just want to check because we know that our viewers. Session low for the Dow is a loss of 305 points. Let me just be clear about that. Right now, we're down 244. So I'm telling you, Keith, the market somehow doesn't like what was said. Specifically, what do you think that was?
Well, I think that the reality dawned on a lot of people that this isn't about rates. This isn't even about inflation. The Fed very clearly wants millions of Americans to lose their jobs, and they want the cost of everything to go up because that's how the Fed thinks it's going to get a handle on this. Now, I personally think the Fed has a fiscal problem. So, you know, I don't take what Powell has to say with anything other than a huge grain of salt. It was important, but I think they ought to take the microphone away, let the market settle down, because the longer they talk, the more uncertainty there is. Okay,
let's bring in Sarge. Sarge, we know that just across to the east side here, you have the UN General Assembly, and I'm surprised the market didn't shudder more when Putin said, I'm not bluffing this time about using nuclear weapons. You have, for weeks and weeks, said, build up on defense stocks. I'm not talking defensive, I'm talking defense, like, you know, the Lockheed Martins and the Raytheons of the world that make our weaponry. Are you still sticking with them? How does this affect your vision at all?
Oh, sure. This is one of the, so to speak, winners in my portfolio to this whole area right now. Thank goodness I'm strong in this group. I'm long Northrop Grumman, I'm long Lockheed Martin, I'm long General Dynamics, some smaller names. I'm not long Raytheon right now. I use that as part of a trade to create cash, so I'm out of it. So I'm missing the fun in Raytheon, but in all the others, I'm still long those names, and I'm trying to focus on the names that are higher tech, let's say more involved in the hypersonic weaponry, where the Russians supposedly have an advantage on us. So because this is where we have to catch up. This is where the money is going to have to be spent. This is where I know the Department of the Air Force, the Department of the Army, and the Department of the Navy are all allocating funds towards these kind of weapons. So I think this is where we have to go right now, speaking just about that specific sector. And it is a leader today. I think it's the top performing industry group.
Well, I'm glad you're wearing a Hawaiian shirt because I needed to see something that made me feel better. Okay, now the Dow's down 311 points. Again, I remind you the losses, the low of the session down 314. Now we're down 313. So please, we want our viewers to keep their eyes on the ticker, on everything that we have in the screen. Keith, I don't want to ignore Treasury yields. Earlier, the 2-year yield hit 4%. That is the highest since 2007. You've got to go back to 2007 if you want to see that. What does that speak to when it comes to equities? I was asking Nancy earlier. She didn't quite answer the question because, I mean, she was definitely focused on important things about the Fed and what it had just done. But why do people perceive that higher rates equal weaker equities?
Well, generally speaking, you're looking at the opportunity cost of investment. So if you've got high rates, you want to be, quote, in secure investments, you can go to bonds. If you have the other way around, you're more interested in growth, you have less risk, you can be in stocks. So, you know, the fact that this moved up raises the cost of leverage that many people on the street are using. This is the part of hidden finance that doesn't get talked about rarely. So when the rates go up like this, the big sell-offs are really computerization and deleveraging. So that's the opportunity for retail investors. So stocks like Lockheed Martin, Raytheon, both of which I own, General Mills, those are the kinds of plays that you can look to today because the street doesn't have an interest in fighting that battle until it deleverages. You can swoop in.
Yeah. Well, if you want to swoop in, we are now having fresh lows. I want to get these right, folks. It's really important, I know. So the new Dow low is a loss of 387. We are down 381 right now. New session low for the S&P is a loss of 46. So we're keeping our eye very close on all of this. And I do just want to mention, because it is extraordinarily important to look at the market mentality, and for that, we look at the VIX. The volatility index is now reverting back to the upside, up 2.7%. Certainly not at the high of the session. It was up 11%, just as the Fed announced the 2 p.m. Eastern 75 basis point hike. Sarge, Keith, thank you very much. We need to get you some individual stock stories here. We just showed General Mills. Let's put it back up.
Hi, it's Keith here. Thanks for checking out today's highlight clip. What'd you think? Did I make sense? Is there something you'd like to add? Make sure you leave a comment down below, and of course, click subscribe to keep up right here on YouTube, or sign up for the email newsletter at the link below. You can also find me on Twitter and Instagram for my real-time thoughts on markets, analysis, and a whole lot more.